Welcome to this week's Dividend Cafe. We are now 3 weeks into January, and so with that, we're done saying Happy New Year. We're officially well into the year, extremely engaged right now in the markets and portfolio management, and enjoying actually a lot of meetings day by day with our clients, and kind of going into review season to just really get an overview with clients on a case-by-case basis about positioning, about changes that may be in order, kind of reviewing 2016. We think a lot of really good things happened last year, and of course just connecting in that way that we love doing. So it's a busy time of year, and then now by the time you're watching this, very likely it is no longer President-elect Trump, but President Trump has been inaugurated, and we enter in a more official context the new administration and all that entails. So from an investor standpoint, where we evaluate markets, the Dow is down about 150 points so far this week going into Friday and Inauguration Day. And come to think of it, we were closed, the markets were closed on Monday. And so in a pretty short week, we're down 150 points. And you know, the markets are up on the year, not a ton, but I mean, overall, there's a lot of good things happening out there, but it's a lot more of the same. We've talked about an anticipation that exists in markets of a lot of things getting done in a Trump administration that may be stimulative to growth, and with that to GDP, and then from there to earnings, which would trickle down to stock prices from an investor standpoint. There's two kind of arguments around where this could go. I don't think I've actually heard anyone articulate it this way, but as I think about it, the advantages that would theoretically be there would be, one, greater earnings as a result of a lower tax liability for a lot of American companies, that less stress in their expense structure because of regulatory cost and compliance with tax code costs, if corporate tax reform leads to simplification, let alone an actual, in some company cases, a reduction in liability. So that's the easy part. There's an obvious way in which that benefits shareholders because there's higher earnings as a result of a lower output for tax liability. But then the other aspect, from theoretically seeing greater growth generated and higher GDP, is that it should lead to higher revenues, and when margins are very, very tight and don't have a lot of room to expand, one of the really only ways, just because of mathematics, that earnings can expand is from greater revenue growth. And so should we get GDP growth that actually kind of breaks out of the real anemic bandwidth it's been in, then that could very well be another leg up for earnings. That's a legitimate enough argument. I just don't happen to believe it's going to happen in a straight line. I don't happen to believe it's going to happen in an easy manner. Some of the things that need to take place will be easier than others. And I would say that, for example, energy infrastructure deregulation is not something that really, to a large degree, will involve Congress, will involve the legislative branch of government. There's certain executive orders that have regulated some aspect of that sector that can be unregulated or deregulated from the executive branch as well. And I believe that will happen. So I think you're going to see a quicker impact for that particular example, the energy sector. Some of the other things that we think are bullish for stocks, bullish for the U.S. economy, are going to take a little longer. We don't know exactly what a repeal replace of Obamacare will look like yet. We don't know exactly what hiccups will take place around a more comprehensive form of tax reform. And so there lies a tension that we have to wrestle with, where we think valuations across the broad stock market are quite stretched. And I'd reference a chart we have in dividendcafe.com this week, comparing the GDP of our economy, the size of our overall economy, to the grand total aggregate value of corporate equities. And that right now that number is high. It's above 100% of GDP. It's nowhere near as high as it's been at the last couple big bubbles that we had. But it's certainly not cheap. And there's been periods where it was really, really low as a percentage of GDP somewhere between 40 and 60%. And in every occasion, the things like that have happened, you had incredible returns going forward as you kind of came out of that trough in valuation. But we're not there right now. And so that's why we believe we need to pay attention to policy, pay attention to things that will benefit from potential changes in the economic framework that we're dealing with. And that's why we use examples of energy infrastructure. There's a lot of stuff I write about this week regarding, a kind of renewed love affair with MLPs or oil and gas pipelines, not just from a policy standpoint, but the economics and a lot of things about the model of MLPs have come back around again and we think make a lot of sense. So valuations are important. We do not want to be excessively bearish right now. We don't see the type of peak euphoria that you normally see that ends a bull market. We don't think valuations are ridiculously stretched. We think they're higher than we like, but we also think that most bull markets see valuations get stretched, and so we don't want to be premature there. We want to be selective, and that's not a cop-out. I mean, it's a really prudent but important, and we think intelligently rational way to approach stock investing right now. Find individual companies and focus where you think you see compelling value on a bottoms-up basis. On an asset class level, we definitely are lowering duration, fixed income, and we've been low duration for quite some time. But we think emerging markets represents on the risk spectrum an opportunity that may require patience, and we're aware of some of the macro headwinds that exist in the EM space as far as short-term movement. But overall, we think that there's a great opportunity to buy companies that are just going to have really accelerating growth for years and years and buy them at prices that are very attractive. So I'm going to kind of wrap it up there. The emerging market story is elaborated upon in the written Dividend Cafe this week. And our attention I've laid out here today, and the thing we're focusing a lot on, how to be selective, how to have high conviction, bottom-up stories in the context of a policy framework, and then to be really sober-minded about what this policy framework will look like. That some things are going to be easier done than others, and that there's going to be some questions as to how all this unfolds. So with that said, we will leave it there for the weekend. We wish you a great weekend, and we look forward to coming back next week. New president and all. That's our story. Thanks for listening, Dividend Cafe.